The silver market is experiencing something we haven't seen in decades, and if you're not paying attention right now, you're going to miss what could be the most significant wealth transfer opportunity of this generation. Let me show you exactly what's happening behind the scenes, because the window to acquire silver at these levels is closing faster than most people realize. Right now, we're witnessing a perfect storm in the silver market that's been building for years, and it's finally reaching a critical inflection point. The fundamentals have never been stronger, the supply situation has never been tighter, and institutional money is starting to wake up to what individual investors have known for months. But here's what most people don't understand. When silver moves, it doesn't move gradually. It explodes. And all the warning signs are flashing that we're approaching that moment. Let's start with what's actually happening in the physical market, because this is where the real story begins. Silver inventories at the COMEX have been declining steadily, and we're not talking about small drawdowns. We're talking about systematic, persistent outflows that suggest something fundamental has changed in how institutions and large investors view this metal. The registered silver available for delivery has dropped to levels that would have been unthinkable just a few years ago. Think about what that means. The registered category represents silver that's actually available to be delivered against futures contracts. When that number shrinks, it means the paper market is becoming increasingly disconnected from physical reality. And here's where it gets really interesting. The silver-to-gold ratio, which has historically been one of the most reliable indicators of silver's relative value, is telling us that silver is still dramatically undervalued compared to gold. Throughout history, this ratio has averaged somewhere around 60 to 1. There have been periods where it's gone much lower, indicating silver was expensive relative to gold, and periods where it spiked much higher, indicating silver was cheap. Right now, even after silver's recent gains, the ratio is still suggesting that silver has significant room to run just to reach historical norms. But what happens if we don't just reach historical norms? What happens if we overshoot to the upside, like we did back in the early 80s or in 2011? Before we go further, I want to mention something quickly. I've put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. If you're concerned about what's happening in the markets and the economy, you'll want to check that out. Now, let's talk about the supply side of this equation, because this is where things get truly fascinating. Silver is unique among precious metals because it's both a monetary metal and an industrial metal. That dual nature creates dynamics that don't exist with gold. Gold is primarily a store of value. It sits in vaults. It gets made into jewelry, but it doesn't get consumed in industrial processes at anywhere near the rate that silver does. Silver, on the other hand, is absolutely critical to modern technology. It's in your phone, your computer, your car. It's in solar panels, medical devices, and countless other applications. And here's the kicker. Most of that silver is used in such small quantities in each device that it's not economical to recover it. It's gone forever. The solar industry alone is consuming silver at a rate that would have seemed impossible a decade ago. Every solar panel requires silver for its photovoltaic cells, and as the world pushes toward renewable energy, that demand is accelerating. We're not talking about a temporary trend here. We're talking about a structural shift in global energy policy that's going to drive silver demand for decades. And the solar industry is just one sector. Electric vehicles use significantly more silver than traditional cars. The push toward electrification of everything is fundamentally a push toward higher silver consumption. Meanwhile, on the supply side, we're facing constraints that most people aren't even aware of. Silver isn't typically mined as a primary product. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dependent on the economics of mining those other metals. When copper prices are low, copper mines shut down, and silver supply drops as a consequence. We've seen underinvestment in mining for years now, and that's starting to show up in production numbers. New mines take years to develop, and there simply aren't enough projects in the pipeline to meet projected demand growth. Let me paint you a picture of what happened the last time we saw a major silver squeeze. Back in 2011, silver went from around $18 an ounce to nearly $50 in a matter of months. That wasn't driven by industrial demand. That was driven by investment demand, by people suddenly waking up to the fact that silver was undervalued and rushing to acquire physical metal. The market couldn't handle that surge in demand. Premiums on physical silver exploded, dealers ran out of inventory, mints couldn't produce coins fast enough, and the price went parabolic. Now, I'm not saying we're going to see $50 silver tomorrow, but I am saying that the conditions we're seeing now are eerily similar to what we saw building up to that move. Except this time, the fundamental backdrop is even stronger. Think about what's changed since 2011. Back then, we didn't have the same level of concern about currency debasement that we have now. We didn't have central banks around the world engaged in unprecedented monetary expansion. We didn't have the geopolitical tensions we're seeing today. We didn't have the same push toward green energy and electrification. All of those factors are now in play, and they're all bullish for silver. Central banks have been accumulating gold at record rates, and that's been well documented. But what's less talked about is what that means for silver. When central banks buy gold, they're making a statement about their confidence in fiat currencies. They're diversifying away from dollars and euros and into hard assets. That same logic applies to silver, but silver has an additional advantage. It's more accessible to individual investors. You can't easily buy a gold bar if you're an average person trying to protect your savings, but you can buy silver coins in small bars. That makes silver the people's money in a way that gold isn't. And speaking of individual investors, let's talk about what's happening in the retail market. Demand for physical silver coins and bars has been consistently strong, even as prices have risen. That tells you something important. It tells you that people aren't buying silver to flip it for a quick profit. They're buying it because they understand that it's real money, that it's a store of value that can't be printed or debased. They're buying it because they're worried about inflation, about currency instability, about the long-term viability of the financial system. And those concerns aren't going away. If anything, they're intensifying. Now, let's look at what the big players are doing because that's always instructive. The commercial traders on the COMEX, the banks and institutions that deal in massive quantities of silver futures, have been reducing their short positions. That's significant. These are the players who typically bet against rising prices, who provide liquidity to the market by taking the other side of speculative long positions. When they start covering their shorts, when they start reducing their bets against higher prices, that's a signal that they see the risk-reward shifting. They're not in the business of losing money. They have access to information and analysis that most individual investors don't. And they're telling us, through their positioning, that they're less confident about silver staying at these levels. At the same time, we're seeing increased interest from institutional investors who traditionally haven't paid much attention to silver. Hedge funds, family offices, and even some pension funds are starting to allocate capital to precious metals as a hedge against the risks they see in traditional financial assets. When that kind of money starts flowing into a market as relatively small as silver, it can move prices dramatically. The entire silver market is tiny compared to stocks or bonds or even gold. It doesn't take that much capital to move the needle. And once momentum starts building, once prices start rising and attracting attention, that's when things can really accelerate. Let me tell you a story that illustrates how quickly things can change in the silver market. There was a period not too long ago when a group of retail investors on social media decided to try to squeeze the silver market. They coordinated buying of physical silver and silver ETFs, trying to expose the disconnect between paper silver and physical silver. Now, whether you agree with their tactics or not, what happened next was revealing. Premiums on physical silver spiked immediately. Dealers couldn't keep up with demand. The U.S. Mint had to ration Silver Eagle production. And this was just from retail buying, from regular people deciding they wanted to own silver. Imagine what happens when institutional money really starts flowing in. Imagine what happens when the industrial users who need silver for their manufacturing processes start getting worried about securing supply and begin stockpiling. That's when you get a genuine shortage. And that's when prices can go to levels that seem absurd in hindsight, but make perfect sense when you understand the dynamics at play. The relationship between paper silver and physical silver is something that deserves more attention than it typically gets. The vast majority of silver trading happens in the futures market, where contracts represent claims on silver that may or may not actually exist in deliverable form. It's a system that works fine as long as everyone's content to settle in cash, as long as nobody actually demands physical delivery. But what happens when that changes? What happens when the holders of futures contracts start standing for delivery, start demanding the actual metal? That's when you find out how much silver is really available, and that's when the price discovery mechanism can break down completely. We've seen glimpses of this in other commodities. Remember what happened with nickel on the London Metal Exchange? Prices went absolutely haywire when a short squeeze developed, and the exchange had to halt trading and cancel trades. That was in a market with actual physical supply. Now think about silver, where the paper market is many times larger than the physical market, where the same ounce of silver might be claimed by multiple parties through different financial instruments. The potential for a squeeze is enormous, and the longer prices stay suppressed relative to fundamentals, the more explosive the eventual move is likely to be. Here's something else to consider. The mining industry is struggling. We're not seeing the kind of investment in new silver production that we'd need to meet projected demand growth. Why? Because at recent price levels, many silver mining projects simply aren't economical. It costs money to explore for silver, to develop mines, to extract and process ore. If the price of silver doesn't justify those costs, the projects don't get built. And that means future supply is constrained. We're essentially borrowing from future production to meet current demand, and at some point, that catches up with you. At some point, the market has to reprice silver to a level that incentivizes new production. And that level is significantly higher than where we are now. The geopolitical dimension of this story is also crucial. We're living through a period of deglobalization, of increasing tensions between major powers, of countries trying to reduce their dependence on the US dollar and the Western financial system. That's driving demand for hard assets, for things that have value independent of any government or central bank. Gold gets most of the attention in this context, but silver is equally important. In fact, silver might be more important for countries trying to build out their industrial capacity, their renewable energy infrastructure, their technological capabilities. Silver is strategic in a way that goes beyond just monetary considerations. Think about what China has been doing. They've been accumulating gold for years, building up their reserves, reducing their holdings of U.S. Treasury bonds. But they've also been securing access to industrial metals, including silver, through investments in mining operations around the world. They understand that control over these resources is going to be critical in the coming decades. They're not doing this because they think silver is going to stay cheap. They're doing this because they know it's going to become more valuable and more strategically important. Now, if you're sitting on retirement savings, if you have money in traditional accounts that are exposed to stock market volatility and currency risk, this is something you need to be thinking about. I've put together information on how gold IRAs work, how you can get physical precious metals into your retirement account without tax penalties. It's in the description. This isn't about speculation. This is about protecting what you've worked your whole life to build. With everything that's happening in the economy, with the geopolitical tensions, with the monetary policies we're seeing, having some exposure to hard assets just makes sense. If you've got $100,000 or more in retirement accounts, you owe it to yourself to understand your options. Let's talk about inflation for a moment, because that's the elephant in the room that affects everything we're discussing. The official inflation numbers, the CPI figures that get reported, those don't capture the real increase in the cost of living that most people are experiencing. Food costs more, energy costs more, housing costs more, healthcare costs more, and the response from central banks has been to print more money, to keep interest rates artificially low, to do whatever it takes to keep the system functioning. But there's a cost to that. The cost is the debasement of the currency, the erosion of purchasing power, the transfer of wealth from savers to debtors, and from the middle class to asset holders. Silver, like gold, is a hedge against that debasement. It's real money, money that can't be printed, money that has maintained its purchasing power over centuries. An ounce of silver today will buy roughly the same amount of goods that an ounce of silver bought 100 years ago. Can you say the same about the dollar? About any fiat currency? The answer is obviously no. And as more people come to understand this, as more people lose faith in the ability of central banks to maintain the value of their currencies, the demand for silver as a store of value is going to increase dramatically. There's also a psychological element to market movements that's worth considering. Markets don't move in straight lines. They move in waves, driven by fear and greed, by momentum and sentiment. Right now, silver is still largely ignored by mainstream investors. It's not making headlines. It's not the hot trade that everyone's talking about, but that's actually a bullish sign. The best opportunities come when an asset is undervalued and underowned, when the fundamentals are strong but the crowd hasn't caught on yet. That's where silver is right now. And when the crowd does catch on, when silver starts making headlines and everyone suddenly wants exposure, that's when you get the parabolic moves, the kind of price action that creates generational wealth for those who positioned themselves early. History is full of examples of markets that seemed stable until they suddenly weren't, of prices that seemed reasonable until they exploded higher. The housing market before 2008, tech stocks before 2000, gold in the 1970s, silver in 2011. The pattern is always the same, a long period of accumulation, of building pressure, followed by a rapid repricing as the market adjusts to new realities. And all the signs suggest we're in that accumulation phase right now with silver. The pressure is building. The fundamentals are aligning. The question isn't whether silver is going higher. The question is how much higher and how fast. Consider the industrial demand trajectory. We're at the beginning of a massive infrastructure build-out focused on renewable energy and electrification. This isn't a one-year story or a 5-year story. This is a multi-decade transformation of how we generate and use energy, and silver is absolutely central to that transformation. Every solar panel, every electric vehicle, every 5G network, every smart grid system requires silver. The demand curve is pointing sharply upward, and there's no realistic scenario where that changes. Governments around the world have committed to net zero emissions targets. They've committed to phasing out fossil fuels. They've committed to building out renewable energy capacity. All of that requires silver and lots of it. Meanwhile, the supply response is constrained by the realities of mining economics and geology. You can't just decide to produce more silver and have it happen overnight. It takes years to bring new mines online, and the easy deposits have already been found and exploited. We're mining lower-grade ore in more difficult locations at higher costs, and with environmental regulations getting stricter, with permitting processes getting longer, with local opposition to mining projects increasing, the barriers to expanding supply are higher than ever. That's a recipe for a supply deficit, and supply deficits in commodity markets lead to higher prices. It's that simple. The monetary aspect of silver is also evolving in interesting ways. We're seeing the emergence of digital currencies backed by physical precious metals. We're seeing blockchain-based systems that allow for fractional ownership of silver bars stored in secure vaults. We're seeing innovations that make it easier for people to use silver as money, to transact in silver, to save in silver. This is expanding the potential market for silver beyond just investors and industrial users. It's creating new use cases, new sources of demand. And as these systems mature and gain adoption, they're going to put additional upward pressure on prices. There's also the question of what happens in a financial crisis. We've been in a long period of relative stability in financial markets, propped up by central bank intervention and government stimulus. But that stability is fragile. It's built on a foundation of debt and monetary expansion that can't continue indefinitely. When the next crisis hits, and history suggests it's a matter of when, not if, where is capital going to flow? It's going to flow to safe havens, to assets that aren't someone else's liability, to things that have intrinsic value. Gold and silver are the classic safe haven assets, and in a crisis, the demand for them can overwhelm available supply very quickly. Think about what happened in 2008. Gold and silver initially sold off as everything did, as investors scrambled for liquidity. But then they rallied strongly as the full extent of the crisis became clear, and as central banks responded with unprecedented monetary stimulus. The same pattern played out during the COVID crisis. Initial sell-off, then a powerful rally as the monetary and fiscal response kicked in. The next crisis will likely follow a similar pattern, but with one key difference. The starting point for monetary policy is already extreme. Interest rates are already low. Central bank balance sheets are already bloated. The amount of debt in the system is already at record levels. That means the response to the next crisis is going to have to be even more extreme, and that's going to be even more bullish for precious metals. Let me share something that doesn't get talked about enough: the concentration of silver supply. A large percentage of global silver production comes from just a handful of countries. Mexico, Peru, China, and a few others account for the majority of mine supply. That creates geopolitical risk. What happens if there's political instability in one of those countries? What happens if a major producing nation decides to restrict exports to keep silver for domestic use? What happens if mining operations are disrupted by labor strikes, by environmental disasters, by infrastructure failures? Any of these scenarios could tighten supply dramatically and send prices soaring. And in today's world, with tensions rising and nationalism on the rise, these aren't far-fetched scenarios. They're real risks that the market isn't fully pricing in. The silver market is also characterized by a relatively small number of large players who have significant influence over prices. The big banks that trade silver futures, the major mining companies, the large industrial users, these entities can move the market with their actions, and increasingly we're seeing signs that they're positioning for higher prices. Mining companies are holding back on selling forward production. Banks are reducing their short positions. Industrial users are building inventories. These are all signals that the smart money expects prices to rise. And when the smart money is positioning one way, it usually pays to pay attention. There's a concept in markets called reflexivity, where price movements become self-reinforcing. Rising prices attract attention, which brings in new buyers, which pushes prices higher, which attracts more attention, and so on. We saw this with Bitcoin, with GameStop, with countless other assets that went parabolic. Silver is particularly susceptible to this dynamic because of its relatively small market size and because of the passionate community of silver investors who are always ready to buy on any dip. Once momentum really gets going, once silver breaks out to new highs and starts making headlines, the reflexive dynamic could drive prices far higher than most analysts expect. And here's something that should concern anyone who's not already positioned in silver: the opportunity cost of waiting. Every day that passes is a day where the fundamentals are getting stronger, where supply is getting tighter, where more industrial silver is being consumed and lost forever. Every day that passes is a day where central banks are printing more money, where governments are running larger deficits, where the purchasing power of fiat currencies is being eroded. The longer you wait, the higher the price you're going to have to pay to acquire silver. And at some point, you might not be able to get it at any price, at least not in the quantities you want, and not without paying massive premiums over spot. The premiums on physical silver are already telling us something important. Even when the spot price is relatively stable, the premiums that dealers charge for coins and bars have been elevated. That spread between paper silver and physical silver is a sign of stress in the market, a sign that demand for the real thing exceeds readily available supply. And if we see a surge in buying, if we see a rush to acquire physical metal, those premiums could explode to levels that make silver effectively unaffordable for average investors. The time to position yourself is before that happens, while you can still acquire silver at reasonable prices with reasonable premiums. Let's also consider the role of silver in a diversified portfolio. Modern portfolio theory tells us that diversification reduces risk, that holding uncorrelated assets smooths out returns and protects against catastrophic losses. Silver has historically had low correlation with stocks and bonds. When traditional financial assets are struggling, silver often performs well. That makes it an excellent diversification tool, a way to reduce overall portfolio risk while maintaining upside potential. And in an environment where stock valuations are stretched, where bond yields are low, where real estate is expensive, where almost every traditional asset class looks overvalued, silver stands out as one of the few areas where you're not paying a premium for exposure. The technical picture for silver is also constructive. Chart patterns, moving averages, momentum indicators, all of these technical tools that traders use to gauge market sentiment and predict future price movements are pointing toward higher prices. Silver has been building a base, consolidating after previous rallies, setting up for the next leg higher. Breakouts from consolidation patterns are often powerful and sustained, especially when they're backed by strong fundamentals. And the fundamentals for silver couldn't be stronger. There's also an element of justice to the silver story that resonates with a lot of people. For years, there have been allegations of price manipulation in the silver market, of large banks using their positions in the futures market to suppress prices and profit from the downside. Whether those allegations are true or not, what's undeniable is that silver has been undervalued relative to its fundamentals for a long time, and markets have a way of correcting these imbalances eventually. The truth comes out. The manipulation ends, and prices adjust to reflect reality. We may be approaching that moment with silver, the moment when the market finally reprices this metal to reflect its true value and scarcity. For those of you who've watched this far, I want to make sure you know about something special. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference, completely free and with no obligation. It's a chance to learn more about protecting your wealth in these uncertain times. The details are in the description. This is only available to people who've taken the time to really understand what's happening, so if that's you, definitely take advantage of it. The bottom line is this: we're at a critical juncture in the silver market. The fundamentals have never been stronger. The supply situation has never been tighter. The monetary backdrop has never been more favorable. The industrial demand trajectory has never been more compelling. And yet, silver remains relatively cheap and relatively ignored by mainstream investors. That combination doesn't last forever. At some point, the market wakes up. At some point, prices adjust to reflect reality, and when that happens, the move is going to be fast and dramatic. The window to acquire silver at these levels is closing. The smart money is already positioning. The question is, are you going to wait until everyone else figures it out? Or are you going to act while you still have the opportunity? The choice is yours, but the clock is ticking and the window is shutting fast.